Welcome back, everyone. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management. And thank you for joining us this week. We have a special episode this week with our guest host, Rebecca Hett from CI. Rebecca's done some work with us before when we took a deep dive into the CERB for Canadian business owners and individuals. She's got a great background, almost 20 years of estate planning and CPA tax specialist. She's a wealth of knowledge, so we always welcome her joining us. So today, actually, Rebecca is going to be taking over the presentation to walk you through everything you need to know about U.S. and your taxes and your involvement with the IRS. So, a lot of people aren't aware or don't realize that they might be actually considered a U.S. person, even if you're not a U.S. citizen. There's a lot of different factors that can trigger that, everything from asset ownership, rental income, or any other type of U.S. income that could put you into that category. Or if you spend a lot of time down there, obviously not this year, no one's spending any time down there, but in normal years, depending on how much travel you have. And even that calculation has been affected by COVID for anyone who might have been stuck down there for a period of time. So Rebecca is going to take us through all that. As always, remember the information that we cover here is really just for your own education. Don't take it as advice. Don't apply it to your own situation without seeking professional advice. We're always happy to answer any questions about your unique situation. Feel free to reach out to us anytime. You can always email us, give us a call. Go to mikeonmoney.com. Our page there gives you a wealth of different videos on education around finance, what's going on in the markets. If you missed yesterday's live weekly update that we do on what's going on in the markets and how COVID is affecting things and what we see for the fall economy, go check that out. And also on that page, you can, there's buttons there to book an appointment directly with me, or as I said, just send us email with any of your questions, or you can give us a shout. If you have any questions for Rebecca, you can definitely go there as well and send those in, and we're happy to follow up on those with you. So with that, I'm going to turn it over to Rebecca. I'm going to take a step back from the camera and let her take control. I'll be back at the end just to give you, again, some updates on as far as questions and what's coming up in our lineup. But with that, Rebecca, I'll turn it over to you.
Thank you, Mike. I appreciate the introduction and the background pieces, and very, very happy to be able to share some information in support of your practice, your clients, on behalf of the team at CI Investments. I'm just going to share my screen right now and get us into, yes, I'm going to stop sharing. There we go. Get us into the deck, the feature show of the day. Just trying to, there we go. There we are. So cross-border matters for Canadian residents. That's the title of this deck. And as promised, it should cover most of the content that Mike, that you sort of alluded to in your introduction. In the agenda, we will take a look at what are U.S. persons. We'll take a look at what are non-resident aliens, and of course Canadians in our example, some tax and reporting requirements regardless of where you fit in either of those definitions. U.S. real estate for non-resident aliens, what are some of the things we need to be thinking about if we as Canadians are going to go own real estate in the U.S., pardon me. And we'll take a look at if we have a retirement plan in the U.S., we might want to bring it up across the border. What are some of the things we want to be thinking about, and some other commonly encountered issues for U.S. persons who can also be Canadian residents. And we'll close with a few comments with regard to the U.S. transfer tax system. So U.S. persons and non-resident aliens, pardon me, you might be a U.S. person for tax purposes if. So number one, certainly if you are born in the U.S., you are a U.S. person for tax. If you are born in Canada, but both of your parents are U.S. citizens, you are also considered a U.S. person for tax. You are then also considered a U.S. person for tax if one of your parents is a US citizen, and then you, the child, were born on or after this date in November 1986, and then your US parent lived in the US for 5 years in total. 2 of those years were after their 14th birthday. And a commonly cited example of this would be Prince Archie from the United Kingdom, who his mother is, of course, Meghan Markle, and now Prince Archie, by way of Meghan's attributes as a US person, he is also considered a US person. If the child was born before November 14th, 86, and then the parent lived in the US for 10 years, 5 of which were after their 14th birthday, then you are also considered a US person. And in this example, we hear the example of Andrew Scheer, who falls into this category by virtue of his father, in my understanding. You're also a US person if you're a green card holder, and green card holders need to be very, very careful. Surrendering your green card for immigration purposes is not the same as for tax purposes. We see a lot of green card holders that think that their card has expired or they are free and clear for tax purposes, and that's certainly not necessarily the case. So green card holders, please be advised to, or not advised, please consider specialized US tax advice related to the criteria and the process that you need to go through to make sure that you are not considered a US citizen for tax purposes as a green card holder. And finally, what's the other way? Many of us are not meeting that this year because of COVID. You meet the substantial presence test. You are considered US person for tax purposes such that you're reporting your world income to the IRS, and you are subject to the same tax reporting obligations as a US citizen or a permanent resident if you are substantially present in the US. So this means you spend 183 days in the US in 1 year, or over a 3-year period, you've spent 183 days in total, counted as, if 2020 is the current year, we take all the days in 20, we take a third of the days in 19, the prior year, and a sixth of the days in 2018. If those days add up to 183 days or more, then you are substantially present in the US, and you are able potentially to rely on treaty relief to sort of get out of that space. But this is sort of the first stop in terms of being substantially present. As Mike mentioned, some relief because of COVID, a notice issued by the IRS that if there's Canadians that are in the US in the period February 1 to April 1st of 2020, they're in the US, they could not have left the US because of some complication related to COVID-19. There's a medical condition exception. They can file this form 8843 and exclude up to 60 days of physical presence in the US if they were in the US during this period of time. So a bit of relief there. Moving over, a non-resident alien, so shifting the focus, a non-resident alien is a non-citizen, non-resident of the United States. So many of us want to have that status so we're not caught in the US tax filing net. How do you be a non-resident alien? You want to keep your total days in the US in the current year or this rolling 3-year period to 182 or less. Part days count as full unless you're traveling between 2 points outside of the US. So there's an exception for connecting flights here. There's an exception for commuters if you're working on one side of the border, living on the other. An exception also for days in the US that are due to medical care for conditions that arose while you're in the US. So rule of thumb, if I want to escape the substantial presence test, I don't want to be considered substantially present, I'm going to keep my stay in the US to 6 months in 1 year or 4 months per year. So sort of 122 days or less on an annual basis if I have a consistent approach to the number of days that I want to be in the US. If I'm deemed US under the substantially present of the substantial presence test, but I've spent less than 183 days in the US in the current year, then I can be treated as a non-resident of the US if I can establish that I have closer ties to Canada through this closer connection exception. This is not available to green card holders, but it is available to those of us who are not green card holders. I'm filing Form 8840 by June 15th of the following year that I triggered this substantially present test. And it looks at the location of home, your family, your personal effects. It looks at all of your economic ties, but also your social, political ties, your business interests. So it takes into consideration a lot of criteria. If my days in the US equal or exceed 183 days, then I still have an opportunity under the Canada-U.S. treaty to establish that I am resident in Canada, not the U.S. And this is done by filing a different form, an 8833. It looks at very similar criteria to the test I just spoke to. This opportunity, this treaty exemption, is available to green card holders. So that's something to think about. A little narrower, but it is available. So tax compliance, one of the most fun things to talk about in this deck of slides. U.S. tax, income tax, who's caught? So certainly our U.S. citizens and our U.S. green card holders, or pardon me, our green card holders, they're filing, they're U.S. persons, they're taxed on their world income, they're subject to a host of additional compliance requirements, and they're filing the U.S. Tax return IRS Form 1040. If you meet the substantial presence test and you spend more than 182 days in the U.S. in the current year, and you are not a treaty resident in Canada, then the same thing. You're a U.S. person, taxed on all your world income in the U.S. and subject to similar special filings. If you spend more than 182 days, but you're considered a treaty resident of Canada, then you're not taxable on your world income and you're likely able to file the U.S. 1040 NR, still subject to a host of other special filings. And if you meet the test, but you spend less than 183 days in the current year, then you're not a U.S. person and you're not taxable on your world income. So depending on how you fit, your filing requirement can change. And so it's incumbent upon each of us who have connection to the U.S. to be tracking our days on a regular basis and understand how that may impact our filing requirements to the IRS. On to filing requirements, good segue. So U.S. persons, typically filing the Form 1040, that's equivalent to the Canadian T1. If you live outside of the US, let me step back. So I'm a US person, I'm also a Canadian resident. I'm concerned that my income is going to be taxed on both sides of the border. There are three key mechanisms that will alleviate the exposure to double tax. Number one is the foreign earned income exclusion that I'll talk about shortly. Number two is the foreign tax credit mechanism that is available. And then number three is additional other treaty provisions that alleviate double tax on income in both countries. So the foreign earned income exclusion, if I live outside of the US for at least 330 days out of the year, or I'm considered to have my tax home in another country, Canada, for example, then I may well be eligible for this exclusion. It's significant, $176,000 USD for 2020, excludes employment or self-employment income earned outside of the US. I still have to file my tax return to claim this exclusion. And interestingly, if we have two U.S. person spouses and they're filing jointly, they're married filing jointly to the IRS, then that exclusion effectively doubles. Married filing jointly is sort of an equivalent to the Canadian income splitting rules that we have. And this opportunity to file jointly is available even if the spouse is not a U.S. person. So that's something to think about. U.S. persons are also obligated under FATCA, Foreign Account Tax Compliance Act. They're going to be filing Form 8938 on an annual basis if their assets meet a certain threshold. So you're living outside of the US and your foreign assets, so from the US perspective, a foreign asset would be a Canadian asset, more than $200,000 on the last day of the year or $300,000 during. This number changes if you're a couple. This is for a single person, but you have to file these compliance forms. The key right now this requirement has been in place for a number of years, but it's really only in the last 10 years that financial institutions are getting on board with the information sharing that they are required to provide to the IRS. So it's kind of like the IRS already knows about us, we're on the grid, and it's up to us as individuals to disclose the assets, confirming in many cases what the IRS may already know, because the financial institution is obligated to provide this same information. And as of January 1st, I believe, of 2020, now our financial institutions are being penalized if they are not providing the information that they are required to under this act. And so, you know, we are all very well compelled to comply, and the ability to sort of hide or escape these rules is really no longer in place. In addition to FATCA is FBAR reporting. This is not an IRS form, it's a different form, FinCEN form 114, and we're required to file this in addition to FATCA reporting if any of our US accounts happen to be $10,000 or more at any time in the year. And this isn't just a bank account that we may own. This also means that if we, pardon me, what I meant to say was non-US accounts. What this also means, if I am the volunteer of the treasurer for my child's student council, and that particular account at some point in the year exceeds more than $10,000 in US currency, then I have signing authority over that account. That puts me into FBAR reporting requirements. So it's very, very expansive in terms of scope. And so you really need to be watching about your requirements. And then there's other additional requirements that we'll talk about a little later in the presentation. If I am a Canadian resident, I'm a non-resident alien of the US, so I'm not a citizen, I'm not substantially present there, I don't have a green card, what are my filing obligations to the United States? Essentially, it falls into two categories. There's the effectively connected income, which is that from US trade or business. It's taxed on a net basis, just like the same income is taxed in Canada. Same graduated rates would apply to the Canadian filing as they would to a US person filing. There's also the fixed determinable periodic income. That's the investment income, that's the pension income, flat tax withheld of 30% source withholding, unless our familiar tax treaty gives us a reduced holding rate. We see 15% on dividends and pension, nothing for interest provided. It's from an arm's length source, no deduction to this. And if that's all the income that you have, the FDAP income, your tax is withheld at source. That really, there's no further filing requirement that you would have to the United States. When do I file a 1040 NR? So like the Canadian T1, the US tax return, but for a non-resident. I do this where I've got US income, but tax liability is not satisfied by source withholding, or I'm actively engaged in a trade or business in the United States. I may want to claim deductions or credits, or potentially a refund of over withheld tax. And a key example of the first line in this section is owning US real estate and having rental income. So I own US real estate, I'm selling it or renting it. I have to report the net income, file a 1040 NR. I'd also have to report the sale, of course. In addition to my reporting on the US side, I have to file a Canadian T1, including the capital gain on sale and the net income converted to Canadian dollars. Here we have the foreign tax credit mechanism, that alleviates or mitigates, likely eliminates any exposure to double tax with the fact that this is reported and taxes paid on both sides of the border. Canadians also need to be mindful of the US transfer tax regime, and we'll talk a little bit more about that towards the end of the presentation. But just to note, I'm in this regime if I'm holding US situs property of a certain value, making my spouse or child joint on a US vacation property, or selling it for less than fair market value to that family member can put me squarely into the requirement to pay gift tax. And on my death, even if my assets are of not a sufficient value, I may still have to file a US tax return. So something we want to be thinking about. US real estate. For non-resident aliens, we talked about filing requirements for rental income and even for sale. This is US source income, so of course the US gets to tax it first. You need to obtain the ITIN if you do not have a social security number. And typically a non-resident alien wouldn't have a social, they would have the ITIN. So rent from US real estate, this is how this works. So I own a US property, I'm renting it out. I need to remit to the IRS 30% of the gross rent received, and there's no reduction under the treaty for this. The withholding rate is 30%. That occurs unless you elect the net rental income method. So you're reporting gross rent and expenses on a 1040 NR. Once you make this election, it's permanent and it applies to all of your US real estate holdings. In addition to the requirement to report the income, there's another act in play called FIRPTA, Foreign Investment in Real Estate Property Tax Act. So this comes into play on the sale of US real estate. And here the purchaser has to withhold. So it's the purchaser withholding from proceeds to pay, and they're remitting to the IRS using this form within a few days of sale. 15% of gross proceeds if the property sold for more than $1 million, and then it's reduced according to property value, providing that the purchaser is committing to living in this property as their principal residence for a certain period of time. There's an opportunity for sellers to get a FIRPTA waiver, but because of the time frame it takes to get this waiver, it can put you offside the filing deadlines for the forms that are cited above, the 8288. And so practically, it's not always possible to get this waiver. And getting this waiver requires the seller to have an impeccable filing history in terms of their US filing requirements. So that's something to be thinking about. And lastly, on real estate, if you are a Canadian, you have a US property, you want to sell that US property, the principal residence exemption rules in Canada and the US are not aligned. And if you claim, if this property qualifies as your principal residence in Canada, which even as a vacation property it could, but you claim principal residence on that, then there's no, you've got foreign tax you paid in the US, but you don't have an offsetting foreign tax credit in Canada. So it can create no opportunity to mitigate the US tax paid if you claim principal residence in Canada on the property. So if there's more than one property that will qualify, you might consider leaving the principal residence exemption for a non-US property. And be thinking about US estate tax exposure. Of course, trust planning is key around this. And also, if you don't want to go down the more extensive trust planning avenue, life insurance. Estimate your tax liability on death and get life insurance in place to deal with it. Some do's and don'ts on US real estate. You wouldn't want to consider a US limited liability company. Putting real estate in a corporation from a Canadian perspective is problematic because you run into shareholder benefit issues. Revocable living trusts, they may be taxable in Canada. And also gifting the real estate is problematic because now you're gifting a US situs asset. Even as non-resident aliens, when we do that, we fall into the gifting rules that we'll talk a little bit about towards the end. Joint property with right of survivorship. This can get us, we can get caught in the transfer tax issues, estate tax liability. You can expose yourself to double tax. So if you're going to hold property jointly, you want to be mindful that potentially tenants in common is the best approach versus joint with right of survivorship. Over to retirement plans, retirement and savings plans, with a focus on transferring them. We've got the 401k. Many investors, many of us hold these types of plans. Statutory tax deferred retirement plan. It's employer sponsored. It's similar to the Canadian defined contribution pension plan. Employer contributions not mandatory. Contributions, however, are tax deductible to the employer, and they're done by the employee on a pre-tax basis. We also have the IRA and the Roth IRA. The IRA is equivalent to the Canadian RSP, and the Roth IRA is equivalent to the Canadian TFSA. Should I transfer, so I may have these plans or I may have other versions of these plans, should I transfer my US-based plan up to Canada? And of course the answer is it depends on the circumstances, it depends on your age, and we'll take a little look at this over the next couple of minutes. The excitement or the relief that is associated with streamlining your investments to one country may make a lot of sense and may be an overriding decision. But there's also, you know, investment restrictions potentially for non-residents of one country investing in another. And I'll leave that to experts such as Mike to talk about that more in other conversations he may have. But certainly that's one thing. Back to the tax side, there's really no compelling reason on the income tax side, because these plans can grow tax deferred. So I can be a US, I could have worked in the US, spent a bunch of years doing that. I might still be a green card holder. I'm moving back up to Canada to retire, be with my family. I can leave my plans in the United States and they can grow tax deferred as if they were Canadian-based plans. So I don't have any concerns about that because of the relief or the treaty allows for this. If I am, there's also some additional you know, flexibility or relief, if you will, with the Roth IRA. The takeaways here that I want to leave are both non-resident aliens and US citizens living in Canada with these plans can leave them in the US on a tax deferred basis. So you don't have to be worried that they'll become taxable because you are living in Canada. And a key decision about moving the plan up across the border is the withholding tax. Where withholding tax applies, it's your ability to claim foreign tax credit for the Canadian tax on the US side that is paid as a result of any transfer up across the border. The ability to claim that foreign tax credit in the year of transfer is a key decision or a key aspect in making the transfer up across the border tax neutral if you decided to take that route. So what are my options? This is dedicated to IRAs and 401ks. There's lump sum withdrawal for sure. You get full income inclusion on the Canadian tax side, plus 30% withholding tax. So maybe I wasn't clear on the last slide. We can leave them in place without tax consequence. There are also mechanisms to allow a tax neutral transfer of these plans up into a Canadian RSP, for example, but it takes a little bit of work to get there. So on the face, we've got full income inclusion on the Canadian side and a significant withholding tax on the US side, and we'll talk about how we clean that up. If the plan owner is under the age of 59 and a half, then there's an additional 10% early withdrawal. So if you're thinking about transferring your plan up to Canada from the United States, you're going to want to wait for the most part until you're after age 59.5. Lump sum withdrawals tend to make a lot of sense if you're over that age, you're close to retirement, and you're wanting to return to Canada on a permanent basis. There's also the opportunity to, if you've got a 401k, you might roll it into an IRA and just leave the IRA in the US. You might take that step because IRAs have more flexible investment withdrawal and even beneficiary options than a 401k. So that's something that you might consider doing. That transfer, if done properly, would be done on a tax-deferred basis south of the border. There's also the idea of transferring a 401k or an IRA to a Roth. For many people, because of certain criteria in being able to hold a Roth IRA, a transfer of 401k or IRA assets into a Roth while you're in the US is really the only option to hold a Roth, which is a tax-exempt vehicle. So that's something that you might want to consider. Leaving the 401k alone is not, that's certainly a possibility, and then moving these plans up into the Canadian RSP. As I've mentioned, good if you want to remain permanently in Canada. Canada allows tax neutral transfer of both IRAs and 401ks to an RSP. And as I've said, if properly planned, RSP room is not required and it can be done on a tax neutral basis. You're thinking about this foreign tax credit issue though. The US notably does not allow transfers of Canadian registered assets down the border across the border on a tax neutral basis. It's really only this one way up. Pardon me, I'm just gonna make sure. There we go. So if I'm going to transfer, I'm making that decision to transfer my plan up to the U.S. What am I thinking about in terms of withholding tax? I've alluded to this. So the treaty gives the U.S. The first right to tax these U.S.-based plans, and so Canadian residents are subject to withholding tax on the gross distribution. What's the rate? Any lump sum transfer is subject to 30% withholding tax under domestic tax law. Any periodic payment gets access to these reduced treaty rates of 15%. Periodic payments are not defined at law, but typically it's payments that are occurring on a regular basis for more than 1 year. If we might think to ourselves, well, I don't want my U.S. asset to have tax withheld at the rate of 30%. I want to have it tax withheld at 15%. So I'm just going to withdraw periodically from the plan, have this sort of periodic withdrawal in place, and then I'm going to transfer it up into my RSP on a tax deferred basis. You can't do that on the Canadian side. We say no. The only way that we can facilitate that on the Canadian side is if we have a lump sum payment. So just by way of example, Canadian tax purposes, I've got transfer of a U.S. plan into an RSP. I've said that the amount of the transfer is $100,000. So $100,000 transfer triggered south of the border. For Canadian tax, I've got an automatic income inclusion of $100,000. I get a corresponding deduction for whatever I contribute to the RSP. At step one, if I have 30% withholding tax, all I have is $70,000 to contribute to my RSP. So to make this tax neutral, I need to find another $30,000 from another source to be able to top up that RSP contribution for the year of transfer. So that's how that works. And then what I'm left with is $100,000 income inclusion, $100,000 deduction, so it's a wash from a Canadian tax perspective. In addition, though, I have $30,000 foreign tax credit for withholding tax at source. In the year of transfer, a taxpayer is allowed to use that foreign tax credit against all other sources of income. So you want to make sure that you're doing this transfer in a year where you have sufficient Canadian source income to absorb that foreign tax credit generated by the withholding tax amount. So those are the key factors, and being over age 59 and a half ideally, to have in place to make a withdrawal or a transfer of your plan up across the border tax neutral. And I'll just conclude with, on this subject, we hear a lot about institutions allowing a withholding tax rate of 15%, particularly if there's a W-8 Ben on file. Technically, 30% is correct, but you still see interpretation that the withholding rate on the lump sum can be 15%. Please check with the plan provider south of the border what withholding rate they are going to apply before you engage in this transfer. That would be another step in terms of the due diligence ahead of doing the transaction. Commonly encountered issues, RSPs and RIFs since 2014, automatic treaty relief, making sure that they're not taxed, they're tax deferred until they're tax deferred, or they're not taxed on either side of the border. RESPs and TFSAs can be problematic, not seen to have the same tax attributes in the US as they do in Canada, and considered in the space of a TFSA, still considered a foreign trust, requiring you to file the 3520 and the 3520A form in addition to any tax filing requirement you might have on the US. There is some brand new relief for an RESP out of this 3520 form, but it did not apply to the TFSA. So holding a TFSA, still, you're a US person, you can still hold it for Canadian tax purposes, tax exempt, but you do have some US tax implications. PFICs. I'm not going to spend a bunch of time on this, but just to know that US persons, whether they live outside of the US or within the U.S., if they are owning non-U.S. corporations that are, considered to have passive assets or passive income, then they're subject to these filing requirements, which are extremely onerous and expensive to comply with. Canadian mutual funds, whether they're trust or corporation, are considered PFICs, as well as ETFs. Canadian holding companies. So if I'm a professional, I'm a doctor, for example, I'm living in Canada and I have my operating corporation and I've got a holding company which is invested in passive assets, that's considered a PFIC, as well as potentially other types of assets. So you're filing on an annual basis the Form 8621. Through that form, there's 3 different filing approaches you can take. You can file you can make a QEF election. That's where you need that annual information statement. So the mutual fund company has to provide an annual information statement for the investor to be able to make a QEF election on the 8621, which is their PFIC filing form. This is sort of the best position from a tax perspective because it allows capital gains of the fund to be treated as capital gains. In the other 2 regimes, you're really dealing with ordinary income tax treatment on the U.S. side, which is more punitive. And also return of capital distributions are not taxed. So you want to fit into for the most part, fitting into the QEF election criteria would make sense. Certainly Canadian T3 and T5 slips are not sufficient to support a QEF election. You absolutely have to have the annual information statement. The AIS is based on the fiscal year of the fund. It's in USD and it's based on US GAAP. There's a lot of different both timing and basis of accounting differences in that form. Canadian T-slips do not help with making the QEF election or filing Form 8621. Just going to shift in the last few minutes to the U.S. transfer tax system. Been talking about that or hinting at that throughout the presentation. 3 aspects to it. So it's an inheritance and a gift tax system. So we have the estate tax, we have the gift tax, and we have the generation skipping transfer tax, which I won't touch on because it's much less, you run into it much less. It's based on value, not gain. That's critical. So in Canada, when we have capital gains, we have growth in our assets, we realize that gain either during on sale during life or as a consequence of our death, we're paying tax on the capital gain and only half of that capital gain is taxable. In the US, this estate tax regime is based on value and the rates are 18% to 40% for 2020. It applies to US citizens and US domiciled persons on world assets. Domicile is more about your permanent home. What is your intention? It's slightly different than residency, but has a lot of overlap in the definition. So income tax in the US focuses on residency and citizenship. The transfer tax system focuses on domicile. It also applies to non-domiciliaries on US situs property only. So if we are Canadian and we hold US situs property, we have to be watching these rules and we have to understand on an annual basis if our estate is exposed to the US transfer tax system, if our assets are exposed to the system. President Trump in 2017 with the TCJA, he doubled the lifetime unified credit exemption. So there's this regime in place that taxes on value, but there's this lifetime unified credit that's been in place for years and years and years, which exempts a certain amount of value of your US property from this regime. This exemption has been as low as $1 million in the last 15 years, I'll say, and it's now at the highest it's ever been. The exemption is $11.58 million. So right now, most people worldwide are not concerned about having to have a liability under US estate tax, but ignoring what's going to happen potentially after the election in November, or certainly when this very, very high exemption rate resets in 2026, you're sort of, the planning is banking on the fact that you're going to pass away before the fall or before the sun sets on this big exemption in 2026. So you really want to be watching for what can happen. It's expected that if Mr. Biden wins, that the exemption will reduce anywhere between $1 and $3 million. And if President Trump wins, the exemption is still set by legislation to be essentially cut in half in 2026. You want to be thinking about that. Just a note, recipients of U.S. assets are not taxed, but if a U.S. person receives a gift of more than $100,000 from a non-resident alien or a foreign estate, then they have to file this 3520 again. And every time you have to file another form with the IRS, most times it's not about a tax liability, but it's about the harsh penalties for failure to file. That's the key thing. Failure to file or filing incorrectly. So if we're not domiciled in the US, only our US situs property is taxable. What is our US situs property? What are we worried about? It's US real estate. It's personal, tangible property located in the US. Typically, it's not our jewelry or the things that we're taking with us on travel, but it's the art and the furniture, our US retirement plans. So where I said these retirement plans can sit in the US from an income tax perspective and we're not worried, we're watching the value of those plans and will it throw us into the transfer tax rules, the estate tax rules, because the value of these plans is considered a US situs for purposes of these rules. So we need to be thinking about two different tax regimes with regard to any ties that we have to the United States. Also includes US stocks and debts of US persons and also of the US government. Does not include portfolio interest, banker interest, and insurance proceeds. Just a little note on planning. Many times you think, oh my gosh, okay, my client is going to be, or I'm going to be caught or exposed to US estate tax rules because I own individual US stocks and bonds. So one of my solutions is going to be to get me out of these rules. I'm going to instead hold Canadian mutual funds that have US tax exposure. So that gets me out of the transfer tax system with regard to those assets, but it puts me squarely in the PFIC reporting requirements. So they compete with each other in terms of exposure and obligation. So you want to be thinking about both sets of rules when we are US persons, what type of assets we're going to hold. If our US situs property on death is $60,000 or less, then there's no US estate tax and there's no estate tax return to file. We get an exemption under US tax law. If the US situs assets are more than $60,000 on death, we have to file, or our executor has to file, an estate tax return within 9 months of our death, even if there is no tax liability. And if both of the following conditions are met, then you might also have an estate tax exposure. Our world estate, so I pass away in 2020, if my world estate is more than $11.58 million, and the fair market value of my US situs property is more than $60,000, then I run through some math and I may have a US estate tax liability in addition to the requirement to file that tax return that I just talked about. Like, how we're doing for time, I feel as though we may stop here just to make sure that we don't go over time. The slides are available for anyone to see afterwards. And the last couple of slides just really talk about, in your particular circumstance, what are some potential planning opportunities to mitigate your exposure to the US transfer tax regime. I think maybe just in closing, just highlight that among the resources in this deck includes a grid that says, this is US property, this is not US property. So the top line of that equation, and then the bottom, the denominator of that equation, what is in your world estate. And just be mindful that any insurance policy of which we have an instant of ownership over will get caught in the value of the world asset. So you want to be monitoring and understanding what value from an insurance world perspective might put you squarely within exposure to these rules. I think with that, I will say thank you, Mike, unless you wanted me to take a couple of minutes to talk about gift tax.
Yeah, you know what? We have a little bit of time. If you'd like to cover that, that's not a problem.
Okay. Just again, so an aspect of the, thank you, Mike. An aspect of the transfer tax regime is the gift tax piece. And that exemption that I talked about, it's called a unified exemption because it takes into account everything you gifted during your life, and then as a consequence of death, what transfers through your estate as a consequence of death. So that $11.58 million, if I'm a US person and I have access to that full exemption, I need to be mindful of what I'm gifting during my life and then how my assets transfer as a consequence of death. For these US citizens and domiciliaries, gift tax applies to their world property regardless of where it is located. And any gifts in excess of annual exclusion, that's what will erode that lifetime exemption. And any gifts in excess of an annual exclusion, you have to report on this IRS Form 709. For non-domiciliaries, so typically a Canadian resident, this gift tax regime applies only on transfers of real property and tangible personal property in the United States. That includes cash, but it doesn't include US stocks and bonds. So a little bit different than what's included in the estate tax piece. We don't have a lifetime exemption available to us. That prorated credit for estate tax is not available from a gift tax perspective, but we do have annual exclusions as Canadians. So if I want to gift, if I am a Canadian resident and I am also a US citizen and I'm married to someone who is also a US citizen, we can gift back and forth between us with no concerns. But if the spouse is not a US person, then you can gift in 2020 up to $157,000 of value to that person. That's still a significant number. And doing this, gifting within your annual exclusions, is one way that people plan to reduce the value of their estate for tax purposes. You can gift to anyone else, including your children, $15,000 per year. And not, offend any rules with regard to gift tax. Charitable donations, are exempt, so you can donate freely. That's just fine. No treaty relief here. The exclusion is the exclusion. And I think, in conclusion, I might just make a comment with regard to renunciation. Many US persons who have just, they suddenly realize they're a US person for tax, or they've known this and they haven't necessarily been compliant, may be thinking about renunciation. That's a big decision, and doing it correctly. There's doing it correctly for immigration purposes or citizenship purposes. There's doing it correctly for tax. They're two different streams. And so you want to make sure that you have a properly qualified US tax specialist to deal with the renunciation. And that person is talking to the qualified immigration lawyer who's dealing with the other side of it. Renunciation is, there's a fee of about $2,500, that's payable to the U.S. government to do that, and then your tax and accounting fees, and of course you have to be compliant when you renounce. We've seen in 2020 more renunciations in the first part of 2020 than ever before, and it seems to be linked to concern around what may happen with the U.S. election coming up, and also what's going to happen to people that have US ties and don't necessarily live in the US. What's going to be their obligation in terms of paying for the tremendous US debt that has been taken on to deal with COVID-19. So some heightened concern and really considering, might it make sense to renounce? If you are not compliant, there's a couple of new programs that are available for US tax purposes to get you compliant, and in some cases, without any requirement to, without any tax liability or penalties in place. So do be engaging with your US tax advisors about getting into these streamlined disclosure programs if you feel as though you're not compliant. As long as you voluntarily go forward and the IRS isn't catching you, then typically there's really good programs in place to get you back into the compliance space. Thank you. With that, I will stop sharing my screen, and Mike, if there's any closing comments or questions, I'm here.
Perfect. Thank you very much for that. I'm just going to quickly put my screen up there. Thank you, Rebecca. I'm always incredibly impressed with your depth of knowledge on multiple topics, and that was great. Obviously, you know, being classified as a U.S. person, there's a lot of reporting to do. There's a lot of extra work to do. And we invite anyone who has any questions to reach out to us. As I mentioned at the beginning, go to mikeonmoney.com or .ca. There you'll be able to quickly access, as I mentioned, phone, email, or my calendar's up there too if you'd like to book a time to talk about your situation. If you have any questions on Rebecca's presentation today, definitely reach out to us. We will make the slide deck available for those who want a copy. And if you have any questions about your personal situation, we'll definitely follow up with Rebecca and get you answers on what you might have to do, or your requirements, or different strategies that you might want to take to limit any U.S. tax liability you might have. And also, if you are thinking of renouncing, we've had, as Rebecca mentioned, I've personally had 3 clients this year start taking the steps, so we can kind of point you in the direction there as well, on if you want to do that. So with that, Rebecca, thank you so much again. We always enjoy having you on, and I hope to talk to you again soon, and let everyone go and enjoy your day, and talk soon. Thank you very much.
Thank you, everyone.